All right, folks. Good evening. It's Tim Davis again here with another weekend market review. Day is May the 1st, 2022. Time is now 5:38. Going to start off this weekend by heading right to this Wall Street Journal information that I like to pay attention to daily throughout the day, which pretty much tracks the sentiment of the market. So it's like the breadth of the market. So, and normally whichever way, the breadth of the market is leaning, whether it be more stocks showing new 52-week highs or more stocks showing new 52-week lows, whichever one is much greater than the other, then that's the way that the market will be leaning. And depending on how much of a difference is, it could be a big lean for a long time. So now, that said, here is, and again, if you guys want to follow this tool, one of the easiest ways to get to it is to, if you are not friends with me on Twitter, here's my Twitter page, at God's Child Tim. This is what it looks like. And I had this pinned to the very top of my channel. As I told you guys before, I got from one of the Market Rebellion chart analysis guys, AJ Monty. So you can also visit AJ Monty as well with Market Rebellion, and you can also get this tool. I just pinned it to my front, the beginning of my Twitter page as well. So those folks who follow me can have easy access to it. So if you click on that, it will bring you to this, and you can look at this throughout the day, because throughout the day you can see where the market is leaning. So as of Friday, April 29th, here is how many new highs were created within the NYSE, the New York Stock Exchange. We'll look at that first. 24 new highs created. Now let's scroll down and see how many new lows were created. 333 new lows created. That is a big difference, folks. That lets you know that the breadth of the market is still down, and down in a big way. That's a big difference between 333 and 24. So the market breadth within the New York Stock Exchange is showing a huge negative imbalance, or a huge move to the continuation to the downside for the most of the market. Here's NASDAQ, 36 new highs created. And look at this one. Look at the new lows. 553 new lows created. So again, folks, the breadth of the market is still down for your long-term buy and hold investors. If you continue to, keep that same strategy in mind, it may take a while for you to, in order for you to see any bounce back, because when I take a look at the charts and show you guys the charts, it's like we are in a longer term downtrend. This is not anything short term, folks. So you need to be mindful of that. With that said, let's switch right over to the monthly chart. Monthly chart is really telling a story, and I want to try to highlight, point out a couple things here, two major things here. So this is monthly charts. Each one of these candles represent a month. So as you can see, it still looks like we are still at the beginning stages of this longer term downtrend. If you look at the full stochastic oscillators, we're pointing straight down. Rand's percentage pointing straight down. I want to point out what the RSI is showing us, because I think it's real important to pay attention to the RSI at this point, because I think the RSI is about to repeat itself as it did back in 2009. So right now, here's our RSI right now, and we are almost at the midway point. RSI on a monthly chart is still showing at 53. Okay, it's showing at 53 is the RSI level. And you can see that 53 by looking to the bottom of my screen, or even over here to the right of my screen. This little gray box here. Little gray box to the right of my screen. It says 53.69. So to get to the oversold level, we got to get all the way down to 30. On a monthly chart, that could take a long time. That could take several months for us to get down to 30. And honestly, I believe we are heading there. If we look at what happened in 2008, 2009, right about this 53 mark that we're at now, we're not even, and that was the beginning of the downturn in 2007, 2008. So that was the beginning, this 53 mark, the beginning of the downturn in 2008. Where do you think we are now? Probably still at the beginning. Now, I think we're going to reach these oversold levels on the monthly chart, folks. That's just what I think. And that could take a long time for it to play out. With that said, look close at this monthly chart. And I highlighted here, we're just in the beginning stages, folks. These last couple months, it's just starting to show, a lot of movement down to towards the downside. But as you can see, we're just getting started. You know what I'm saying? We haven't even got back to this level where we fell from at the beginning of the COVID plunge. I think we're going to hit that level soon. And that we'll probably find some support there, maybe find a little bounce. But I ultimately think we're probably going to continue down, and it's a huge possibility we can retest the lows that we've seen back with the COVID plunge in 2020. So keep that in mind, folks. We are in a longer-term downtrend, and it is not set. I'm letting up yet. That's a monthly chart of the Dow Jones. Let's take a look at quick glance at a monthly chart of the S&P 500. Here's our S&P monthly chart at a quick glance. So S&P, same type of scenario as the Dow Jones. Look at that. So we are in this longer-term downtrend, longer-term downtrending cycle or downtrending channel. And like this is going to possibly continue, folks. I really believe it's going to possibly continue until the RSI on the monthly chart hits oversold. That's my personal opinion. All right. Now let's take a look at the SPXA 200R, which is the tool that tracks the percentage of S&P 500 companies trading above the 200-day moving average. This one also is a big telltale sign, folks. This one is already hitting oversold territory, but it's just bouncing off of those. It's just hitting it consistently and bouncing. And as you can see, we're starting to get our first red TTM squeeze bar below here on this monthly chart. So that tells me that we could have a longer way to go. We're starting to get our first red bar. We could have much longer to go. I ultimately believe that we're going to really test this zero line area on a monthly chart where we can have almost all stocks trading below their 200-day moving average. So I think that is a possibility. So there's something to think of, folks. Buy and hold investors, just beware, because it may take a long time for you to retrieve or for you to get back to even break even. And I'm going to show you guys, what that looks like, because if you look at the S&P 500 monthly chart again, I'm going to show you how long it took for investors who invested in the market back in 2000 or 1999. I drew this trend line to show how long it took for those folks to actually break back even. So from 2000 or 1999 all the way to 2003, there was a pullback in the market. Market bounced at that point from 2003 up to 2007. But if you see where I got this trend line drawn, that's only the break-even point, because that's where the market was. That's where the market was at back in 2000 or 1999. Just back to the break-even point. So nobody made any money if they bought back here at the top in 1999. They only broke even in 2007 just to see that money get lost again and go even deeper, dive even deeper. So then it took another several years in order for them to get back to break even, and then they started making money. With that said, you do the math. Track the year 2000 from the year 2013. You can see the years at the bottom, and the my line lines right up with that breakout point where we continue to go higher above that level that we dropped from back in 2000. Folks, that's 13 years. It took 13 years for those folks who bought back in 2000 at the top of that level. It took them 13 years just to see a profit. So within that 13 years, they really didn't make any money. They pretty much were in the negative up until 2013. That's crazy. So that means folks who were, trying to live off retirement for those 13 years, and some folks probably even died during that time, I'm saying, in a hole, and they didn't make any money. So I say that to say, be careful of where you jump into this market right now for you long-term investors, because if we continue to go down and start hitting some historical lows, it could take 13 or 14 years for you to see a profit. That's just something to think about, okay? All right. So we took a look at the SPXA 200R. We took a look at the S&P. We took a look at the Wall Street Journal data that shows the 52-week new highs versus 52-week new lows. Now, let me just glance at the VIX. Folks, I'm really just glancing at these long-term charts because there's no need to continue to look at some of these shorter-term charts unless you're day trading, because the daily chart, 4-hour chart, it's really, it really, and now that you trading, taking bearish bets, but these charts are pretty much, to me right now, are useless, because it looks like the sellers are really kicking in the overdrive and really selling this market. Every time we get a bounce, there's a huge sell-off. So every time I see a bounce, I just continue to add to my put options, or my positions that I use to play the market on the downside. Because trying to play a short, play these rallies is just going to get you stuck if you don't get out at the right time. So excuse my dog, folks, but I want to get through this too. So again, let's take a look at the VIX real quick, and then that's all I really want to show you guys is just what this market is doing, folks, and just beware. Here is a daily chart of the VIX. I drew this triangle last week before we had this breakout. I said that this looks like a setup for a possible breakout of the VIX out of this triangle pattern. And what did it do? It did exactly that. Close above that level of the breakout. Got to see how the markets open up in the futures on Sunday after 6 p.m. But my speculation is that we could probably see some more selling, folks, at the beginning of the week when trading resumes on Monday morning. And I think ultimately we're going to break this upper trend line you see me have drawn here. We're going to possibly break that level probably real soon. Possibly make a move up towards 40 before the market starts to see a relief rally. And I'm only going to call it a rally within a bear market, because that's all it's probably going to be, a relief rally. If we, VIX hits that $40 level, we can start to see some type of relief in the markets to a big move to the upside. Then we have to see where markets go from there. All right, but right now, folks, the bears are in full control of this market. Keep that in mind. The bears are in full control of this market. The bulls are just getting a little glimpse here and there, a little rally, and then the bears step right back in and put their teeth and claws into this market and continue to drive this market lower. And I think there's much lower prices ahead. So be mindful of that. Play the market wisely. If you don't know how to trade, don't know how to play the market to the downside, there's plenty of books and videos you can watch on playing the market to the downside, or just inbox me personally and I will direct you and put you in the right direction for you to learn how to play this market to the downside. And for those folks who are local in Baltimore area, I'll be doing a live in-person session very soon at a local barbershop for those folks who are interested in learning how to play this market to the downside or protect your portfolio now, so that you won't have to wait 13 years to see some type of profit. Okay. Folks, this is really, really something that you really got to, if you have not been paying attention to what's going on throughout our world, throughout our economy, you've been hiding underneath a rock. We are definitely in a big bear market, and now a lot of analysts are believing that we're heading for a recession. So that's all I have for you guys this weekend. I just wanted to keep it real short just to show you guys what we need to pay attention to as we approach another week. Until next week, it's Tim Davis. I'll be signing off, and I'll be catching up with you guys throughout the week on Twitter and in Discord and in all social media outlets that I follow. All right, I'll catch you guys next time. Peace.